Hey guys, it's Liquid here again. Have you ever wondered how you can make better investment decisions? Well, a useful way to develop a winning strategy is to ask the right questions. So here are 7 key questions you can ask yourself before making any investment decisions. This process will help you make a more informed decision and increase your odds of getting higher returns. 1. What is the expected rate of return? If you don't know much about an investment, then your perceived prospects are like 50-50, which just means you shouldn't invest in it because at that point it's just a coin toss, so you're just gambling. But if you think there's a 60 or 70% chance of success or higher, then it might be worth considering. To increase your chance of success, you must know how to accurately assess the odds, and you should also have the discipline and patience to act only when the odds are in your favor. The higher the odds, the better. If your analysis is accurate, then you can be certain this strategy will work due to the law of large number theory, meaning if you do enough of these kinds of deals, then eventually your overall return on average will get closer and closer to what the expected return is. But here's the tricky part. It's not enough to just be right more times than being wrong. What's most important is how much money you make when you're right and how much money you lose when you're wrong. So that kind of leads to the second question, which is what's the upside? So, how much money can you make on this potentially? If it's a bond, then you're basically going to get the coupon plus maybe a little bit of appreciation depending on where interest rates go. If you have a blue chip dividend paying stock, then you might expect to see 8 or 9% annual returns over time. You want to keep your expectations reasonable here. And if you have a high flyer stock, something that could potentially give you a 10 times return in a few years, you have to kind of balance that with what is the most likely rate of return, which is however you answered question number 1. And of course, a corollary to what's the upside is the third question, which is what's the downside? So, how much of this investment can you lose, and what are the chances that it will lose that much? The best kinds of investments are ones that will give you a large margin of safety between what you can make on the upside and what you can lose on the downside, and also provide a high expected rate of return. The fourth question is what's your exit strategy? Having an exit strategy before you even get in prevents you from trading on emotions and making bad decisions later on. You need to come up with a systematic plan to sell the investment and commit to it. You can also consider is the investment liquid enough for you to sell out when you need to. It's harder to make these kind of decisions after you've bought an investment already because once you have skin in the game, you become biased. You can also ask who else is interested in this investment. You should at least know who you're trusting your money with. Things to look for are long, successful track records and compensation programs that reward performance. You can also look at how many institutional investors are holding the asset. These are large pension funds and endowment funds that have to scrutinize all possible aspects of a security before buying it. Another question you can ask yourself is how will this investment help me accomplish my financial goals? In other words, what are you trying to accomplish with this investment? If it's going to be money for retirement and you're not going to touch it for 30 years, then you probably want to, for example, not buy any bonds because over the last century, stocks have outperformed bonds pretty much 100% of the time over any 30-year period. But if you're saving up for a down payment in a couple of years, then maybe you want to invest in something with relatively low volatility. So the investment should line up with what your personal goals are. And then the final question is to ask yourself, do I have an edge here? Famous investor Peter Lynch thinks that ordinary people have a large advantage over institutional investors. No investment professional will ever know more about an industry than someone who works in it. So maybe you're an engineer and your company just switched to a new software or tool that is much better than what your company used to use. Maybe that could be a game changer for the industry, so you can catch the trend before it really takes off. Or maybe you're a building contractor and you notice a certain type of material or brand is becoming more popular with developers and home builders. Or maybe you work for a logging company and you sell lumber. Well, if that's the case, then you are exposed to important pricing information before the official economic data gets published and is seen by people on Wall Street. If you work in agriculture, you will have first-hand knowledge of which types of machines are easier to service and easy to operate. All of these are just examples of specific knowledge that's only known by a fraction of the general population. There are tons of potentially interesting assets you can buy, but there's no such thing as the perfect investment. The point of asking these 7 questions is so you can screen your options and narrow down your choices, which makes the process a lot easier. I certainly ask myself these questions when I decide on whether or not to invest in something, and I hope you find them useful as well.
So happy investing, and until next time.